because we have so much debt now, and so much of that debt is bad debt, that it's impossible to use history to make accurate predictions anymore, because we're dealing with a society that is so much more overleveraged than it used to be, and therefore so much more fragile that we could have governments around the world just immediately reliquefy, and then we go back into an inflationary boom, or we could have everything just fall apart and governments just not be able to deal with it. Because remember, governments are so indebted right now that if they go for mass reliquefaction of the global financial system, it could be that that just shifts pressure over to the currencies.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back John Rubino. So, John, thanks so much for coming back on the podcast today.
Hey, Anthony, thanks for having me back.
No problem. And it's probably been about 6 months, and a lot has happened over that period. So I'm keen to get your intakes and insights into what we've seen. But just from your perspective, is sort of where I start with every guest. What are you currently seeing in the economy and markets overall?
Well, I think this is classic end of cycle behavior now in the markets, where you've got people who have basically run out of extra savings, and now they're maxing out credit cards in the U.S. You've got governments terrified by what they're seeing and running big deficits, which is one of the very few things that is keeping the U.S. economy from tipping over into recession. But then you've got stocks and houses priced for perfection. So combine lower consumer spending, maybe negative consumer spending because consumers are tapped out, with overpriced assets, and you get a classic crash scenario followed by a recession. And I think that's the most likely scenario in the U.S. And I'm less sure in Europe, because Europe is a very complex situation right now. But the U.S. is classic. I mean, we've been through this 3 or 4 times in my lifetime. And every time stocks were supported by just a handful of big companies that people thought would go up forever, and houses were completely unaffordable, and personal savings went down to zero. You got a recession. So that's my prediction for the year ahead, is that we do what we have done every time in the past that things have gotten this out of balance, and we end up with a potentially nasty recession, a potentially big equities bear market, and all the chaos that normally flows from things like that.
Okay, so you don't buy into the message that Fed are going to cut. It's going to be great for the markets and the economy. It's going to provide extra debt throughout this economy and extra stimulus.
Well, the Fed is definitely going to cut, probably too little, too late to stop a downturn. But they're going to cut aggressively when the time comes, because really all the Fed knows is easy money. If there's a problem in the world, they address it with lower interest rates and quantitative easing, and they'll be back to that without a doubt. But there's a limit to how much slightly lower interest rates can improve the situation of somebody who, say, is having to put day-to-day life on a credit card and is seeing their credit card interest expense go straight up, just totally parabolic from here. I mean, when you reach that point, there's not really much left to help you. You're going to have to default in some way, or else just cut back on your standard of living in a draconian way, which means you're not going to spend much out there regardless. And so many people in the U.S. are in that situation. So, having car loans go from 10% down to 7%, or mortgages go from 7.5% to 6.5%, that doesn't fix anything for these guys who are rapidly going broke because their credit cards are eating them alive. So I think the Fed will try, the Fed will fail, and then we're going to see some very aggressive stuff out there with, for instance, the government buying equities. Things like that are going to happen in the next cycle, but that's a while away. We got to have the emergency first, and that's my main prediction, that we have a 2008, 2009 kind of crisis in which perhaps commercial real estate rolls over in a big way, and that impairs the local and regional banks in the U.S., which causes a crisis, which causes the government to step in and bail everybody inside out, and causes the Fed to cut aggressively, but the process spooks everybody, so stocks tank and the economy contracts. And I think that's a scenario that at least some part of which is going to come true in the not too distant future.
Okay, and yeah, it's hard to predict what's going to happen, but you see it being another credit event like we saw in 2008 to do with
Yeah,
real estate.
there's too much bad debt out there for there not to be some kind of a credit event because, look what's happening with office buildings, for instance. And in the US, an awful lot of big office buildings went up over the past 10 years, financed with extremely cheap money. So now you've got a lot of these buildings post COVID, when people found out they could work from home. A lot of office buildings are not nearly as full as they need to be to generate the cash flow to pay off their debts. At the same time, the interest rates they've got to pay to refinance their debts are way up. So you're going to see a lot of office buildings be sold for a fraction of what they were sold for last time around, which means that the banks in the US have all kinds of unrealized losses that they're going to have to make public pretty soon. So that alone, right there, even if everything else was in pretty good shape, that process alone would be worth a recession. So there's that, and then there's all kinds of other things going on. That, we haven't even talked about geopolitics. We're on the verge of World War III in a couple of places, and not including China, where we could easily blunder into a shooting war in the not too distant future. So, let those things happen, and then it doesn't even matter what the finance world is doing. We've got a recession followed by an equities bear market, just out of fear of what happens when Americans and Russians start killing each other.
Yeah, lots to talk about there. But if we stay on sort of the finances for now, so I think the banks might benefit with if the Fed continued to cut interest rates and if yields sort of come down, and hopefully the government bonds that they own, the part of the value that the book value of those loans will sort of be close to par. So then if they have people withdrawing their money from the banks, they'll be able to sort of make them whole. Not like what we saw in 2023.
Lower interest rates help banks up to a point because, as you said, it raises the value of the government bonds on their balance sheets. So that right now is a big source of unrealized losses that's got everybody spooked. And if interest rates go down and the price of government bonds go up, then that lowers the magnitude of those losses. But normally the way things work is that you have a crisis in some part of the credit market or in equities right around the time the Fed starts cutting in the US. So it's not that things get better when the Fed starts cutting, it's that things get dramatically worse just as the Fed is cutting. And so you have a year or a year and a half crisis before lower interest rates and a rising money supply have their effect. That's the way it's happened, well, basically since the 1970s. So for my entire adult life, which is pretty long at this point, that's the way it's gone. And we're back in that kind of a situation again. So I suspect it'll go the same way. Unless, one thing that would short circuit the immediate crisis scenarios, the Fed comes in and cuts interest rates by multiples of a point. In other words, instead of half a point, they do 2 or 3 percentage points off the Fed funds rate. That's not going to happen. That's too big of a move in too short of a time. And that even might backfire because it might imply to the markets that the Fed is panicking because what they see is so much more horrendous than what is being reported in the mainstream media right now. So there's no real solution at this point when you've got a zero savings rate and falling consumer spending and geopolitical chaos and an incipient banking crisis. You throw all these things together, and yes, the Fed is going to cut, and yes, they're going to go to QE again in the not too distant future, and yes, the government is going to run $2 trillion deficits. None of that fixes all these imbalances. You can only fix these imbalances with a lot of these debts being wiped out, and that has to happen through default at this point.
Okay, I know some people have mentioned that they could be sort of similar to what we saw in the 90s, where they did the magical soft landing where inflation came down. There was sort of a small uptick in unemployment. They reduced interest rates, and then everything was okay. But you think it's sort of too far gone for a scenario like that?
The imbalances this time around are immense compared to the 1990s. People forget that in the 70s, 80s, and 90s, we actually had pretty good finances in the US. The amount of debt relative to GDP was minuscule compared to what it is today. And consumers weren't nearly as indebted. Credit cards hadn't really taken off yet, become a thing that you put your gas on and your groceries on or anything. So we were able to handle slight increases in interest rates in the 1990s with much less trouble. But what happened in the 1990s? We raised interest rates a little bit early in the decade. There was a little bit of a mini crisis in 1994. And then the dot-com bubble started and everything just exploded. And at the same time that was happening, the Fed was stepping in around the world, bailing everybody in sight out. So you still did have really aggressive interventions in the market. But now, consumers are vastly more indebted than they were back then. The government debt is 3 or 4 times as high, not just nominally, but in terms of percentage of GDP as it was back then. And it's global. And we've already had our version of the dot-com bubble in the AI bubble of the last couple of years, when a handful of stocks just went from being a few $100 billion market cap to $1 trillion plus. So we've got a stock market that's supported as it was supported by a handful of tech stocks in 1999. So we're set up as if it's 1999, not 1994. And that means that there really isn't a solution except a repricing of all this stuff. Houses are as unaffordable as they've ever been. They have to go down by 50%. The cost of a house. That includes the mortgage. So interest rates going down will help, but prices also have to go down at the same time. So you got to cut the effective cost of home ownership by half, which is very deflationary. And stocks are wildly overvalued, and they're supported by just like 10 big tech stocks. So the S&P 500 and the NASDAQ have to go down by their typical 20 or 30 or 40% in an equities bear market before we get back to fair valuation. So all these things have to happen. We have to have all these repricings. And that usually takes place in the context of a recession. And usually the recession is caused by that repricing. So I think that's where we are. We're 1999, not 1994. And there is no easy, pain-free way out of this right now.
So if you look at, I guess, recent, volatility, we saw there was a few weeks ago, there was sort of the flash crash where Nikkei went down, 20%, and then sort of recovered, as well as a few other US indices. And then we look at 2022, I guess that was a bit more of a long drawn out drawdown, but then COVID was a very sort of quick crash. So do you think there's going to be a bit more of a longer, drawn out sort of recession, I guess, market move, or do you think it's going to be something like that where it's just a real quick flash crash
Yeah, this is where it gets interesting, because we have so much debt now, and so much of that debt is bad debt, that it's impossible to use history to make accurate predictions anymore, because we're dealing with a society that is so much more overleveraged than it used to be, and therefore so much more fragile that we could have governments around the world just immediately reliquefy, and then we go back into an inflationary boom, or we could have everything just fall apart and governments just not be able to deal with it. Because remember, governments are so indebted right now that if they go for mass reliquefaction of the global financial system, it could be that just shifts pressure over to the currencies. Because remember what happened in 2020, when we started massively increasing the global money supply in order to deal with the pandemic shutdowns. We got double-digit inflation in the U.S., or almost. The official inflation rate in 2022 was like 8.9%. And that was traumatic for the people who were hit hard by it. A lot of people saw their cost of living go up by a third in the space of like 4 years, and they're still not out from under. They're the guys putting day-to-day life on credit cards. So if that were to happen, in other words, if an aggressive easing by the world's central banks led to a plunge in the value of the world's currencies, then all bets are off. The fiat currency would fail at that point. And we would have the Austrian economics crack-up boom, where a critical mass of people figure out that it's their government's policy to continue to inflate away their currency, and they just blow off the currency. When they get paid, they buy real stuff instead of letting their money sit in the currency, and that pushes the price down of the currency even further. In other words, you get a self-fulfilling prophecy of a hyperinflation when people give up on a currency. So it doesn't even matter what the money supply growth is, it's that people have given up on it. And that's historically the end for that currency. So that's a real possibility this time around. It's not guaranteed because, like I said, you can't make accurate predictions about the financial system when you go into a crisis with this much debt, because that debt makes things inherently unpredictable and unstable. So here we are. And I think from an investor's standpoint, you have to take into account the worst case scenario possibility here, where the currencies just die, and I think you need to be extra cautious with investing. And the question is, the intellectual challenge here is to define what cautious is in a world where currencies are the main source of the problem, the epicenter of the crisis. So, because do you want to own equities? They might go up in a currency collapse. Do you want to own bonds? They might evaporate in a currency collapse. Gold and silver, probably great. Energy assets, probably great. Farmland, more than likely, really good. But what kinds of equities? If you decide to own equities, do you want to own gold miners or do you want to own bank stocks? There's a lot of things to think about when you're in an environment where your currency is the problem. And it's at least conceivable, if not probable, that that's the next cycle. The rest of our decade, excuse me, is the end of the fiat currency experiment with all that involves. It's a fascinating time from the standpoint of being an economics nerd to watch this gigantic experiment finally fail. But it must be horrifying for regular people who don't spend all day long obsessing over this stuff and thinking about what would I do in this scenario. Regular people are the ones who are going to be hurt by this. The guys who trusted the government and held a lot of currency in bank accounts or in the equities of financial companies or government bonds or whatever, they're the ones who are going to be hurt by this. And that's why inflation is such a despicable public policy, because it enriches the already rich and it hurts and sometimes destroys the people who weren't rich to begin with and who trusted the government to take care of them. So yeah, you and I are going to have an awful lot to talk about in coming years, because the kind of chaos that is likely is going to be fascinating and terrifying at the same time.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views. We've hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student and now currently working and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So yeah, if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. Yeah, it's definitely going to be very busy if all that happens. So yeah, I'm not sure if you heard of the sort of milkshake theory about the dollar and how it's actually going to be sort of one of the stronger currencies, I guess, when this collapse is happening, because it's the world reserve. They can print their money. Is that sort of something that you buy into, that all the other currencies might really struggle, but the US dollars is going to be sort of
it's one of those ironies of our situation in the US, is that when there's a crisis in the world, even if we cause the crisis foreign capital flows into the U.S. because even if we're at war, we're doing some other crazy thing out there. The global financial system, investors around the world perceive the U.S. to be the safest place to park cash in a crisis. So the dollar tends to go up relative to other currencies in a crisis. But remember, we almost had double-digit inflation already. In other words, the dollar almost lost 10% of its value in official terms and probably did lose 15% of its value in just 2022 alone. So it's possible for the dollar to be strong relative to the euro and the yen and pound sterling and still be falling in purchasing power at 10% or more a year. So that's another thing we have to think about is how are we going to actually value our currencies? Are we going to look at them in relative terms, their exchange rates versus each other? Or are we going to look at them in terms of purchasing power? In other words, what can you buy with that currency? How much bread and milk and oil and gas? And I think the latter way is more accurate. So we could see the dollar being quote unquote strong at the same time that its inflation rate, the inflation rate in the US, is 10 or 15%. Once again, it's an intellectual challenge. You got to figure out how you're going to define things and how you're going to act based on those definitions. But I would say a currency that's falling in terms of purchasing power by 10% a year is not a strong currency under any circumstances. If it's going up versus the euro, that just means the euro is even a weaker currency. And I think we've seen a lot of that lately. The big currencies have all lost large amounts of their value. But they've been more or less stable against each other. So, you can look at the dollar and the euro and the yen and think, okay, more or less stable currencies. Well, the yen is actually kind of falling kind of hard, or it has been. But, it doesn't look like a crisis when you look at currencies versus each other. But if you look at their purchasing power and their inflation rates, it is indeed a crisis that we've lived through and that we're headed back into.
And what do you think would be pricing? Do you think there could be sort of another reserve asset like gold or Bitcoin or something new that could sort of come to the forefront and be that global asset?
Yeah, I think we have to choose something else. We've got to go to another standard at some point. We'll have the Jim Rickards monetary reset that he talks about at some point. And the question is, what will it be? Like central banks right now are aggressively buying gold, which implies two things. One is that they're sick of dollar hegemony. The US uses the dollar as a weapon. We bully everybody in the world. So owning dollars as a reserve asset is kind of making a political statement. You're saying you're on the US/NATO side of the coming global conflict. And a lot of countries don't necessarily want to send that message. So they can replace their dollars in their reserve assets, foreign exchange reserves, with gold, which is a neutral asset. Gold, by buying gold, you're not really taking sides. You're just buying this asset that has been a reserve asset for 3,000 years, and you're backing your currency with it. So that's one thing that's happening. At the same time, there's a lot of capital flowing into Bitcoin. And Bitcoin is starting to be used as money. I mean, I don't want to get ahead of that. It's not money yet, functionally. But people are starting to look at it that way and treat it that way. So it's possible that that cryptos play a role in the monetary reset. I have no idea what that role will be, but it could be that they're in the mix, especially Bitcoin, maybe Ethereum, maybe a handful of other cryptos. We'll see. But that remains to be debated. And we have to have the crisis first where it's conceivable for governments to give up on the current monetary system. And they're looking at it as maybe the best option out of 3 or 4 horrendous options, because the other options are a Weimar style hyperinflation or a 1930 style deflationary crash and the French Revolution, where the peasants got their pitchforks and they went to the castles and pulled the aristocrats out and beheaded them. We're looking at least metaphorical scenarios like that. And if a currency reset is the fourth option, a lot of governments are probably going to choose that. And they're just going to give up their power to create currency out of thin air, as much as they hate doing that. And they're going to go back to something like maybe a gold standard. So, and of course, it'll be with gold at $10,000 or $15,000 an ounce. which completely upends the wealth distribution in society when that happens. But again, it'll be the people who trust the government and hold dollars or euros or pounds sterling who are hurt by that, and the stackers and the gold bugs and the already rich people who all own lots of gold and silver who are enriched further by that. So there's going to be political unrest that goes with that, as all the people who got screwed over by their governments don't take it well and hit the streets. But it could be seen as the least bad option at some point in the coming decade.
And what do you see is happening, I guess, with the precious metals and the miners markets? Because I think, I was trying to think of who said it, but I just can't remember, unfortunately. So apologies if the contributors listening, but they were talking about how, I guess, the sort of emerging markets and the BRICS are buying gold while the West is selling gold and sort of the actual assets. And then the West are selling the sort of gold miners and the precious metal miners, but the sort of BRICS aren't buying the miners. So that's why we're seeing, I guess, the asset appreciate because there is that large buyer, but for the miners, we aren't really seeing that appreciation. So is that sort of what you're seeing as well, or what are you currently seeing with both the markets?
Well, that is definitely part of the story. You got central banks aggressively buying gold, but they're not buying gold miners. So there's a lot more wind at the back of the metal than the miners. Normally, when gold goes up, the gold miners go up even more. And two things are happening that are causing that right now. Well, the first thing you mentioned. The second is that mining is a really hard business all of a sudden. It used to be that if you had a gold mine in Chile or Mexico or even Canada, you were pretty well guaranteed that the government was going to leave you alone to do your thing. But that's not the case necessarily anymore. A lot of countries are they're nationalizing their resources. Who was it, Mexico that just nationalized their lithium resources? Maybe. And Chile is thinking about doing the same thing. Mexico is now talking about nationalizing their silver mines. So all of a sudden, miners do not look nearly as the big solid miners don't look risk-free anymore, put it that way. Oh, and then Cobre Panama, there was one of the world's biggest copper mines was just closed down by the Panamanian government. So all of that stuff's happening, and it's making the miners look a little bit less of a sure thing than they used to. Now, having said all that, gold at $2,500 US an ounce covers over a lot of those problems, right? Because if you're Agnico Eagle or Newmont, and you're producing the same amount of gold this year as last year, well, you're going to get 16% or so more dollars for each ounce of gold that you're selling. And if you're well run, which those guys are mostly well run, that increase in revenue goes straight down to earnings and cash flow, and it makes your numbers look a lot better. And in the second quarter, the big gold miners generally reported pretty good numbers, in part because the price of what they're selling went way up. So, let central banks keep buying gold and keep pushing the price of gold up, or at least supporting it. And that translate into higher earnings for the miners, then people are going to start buying those stocks regardless. I mean, they already kind of are. The mining stocks are up. The big solid mining stocks, anyhow, are up reasonably. And that momentum will increase if people start thinking, okay, $2,500 an ounce for gold is real. It's going to be there for the next 2 or 3 years. Now I can do my spreadsheet and see what that means for Agnico's cost or cash flow, and I'm going to get a really nice number, and so I'll buy the stock. So that kind of thing will happen. And then it filters down to the smaller players in the space, because if the big guys have excess cash flow, they're eventually going to start using it to buy the little guys. And that will light a fire under the junior miners and under some of the explorers that have really, really good-looking deposits that they're proving out and everything. So you'll see that money filter down, and you'll see the little volatile stocks in this space go up more in percentage terms than the big guys. But it works in stages. First the generalist money flows into Agnico Eagle and Newmont and Barrick. Then it flows into the mid-range guys, and then it flows into the explorers. So we have a 2 or 3 year process here, with the central banks leading the way. Central banks are buying gold, and that flows into the miners in stages. And I think there's a reasonable chance that we see it play out that way again, as long as geopolitics doesn't turn completely crazy, where a couple of countries just nationalize all their natural resources and just kick the miners out of the country. If we have that, then that's tricky. But if we don't have that, then I think miners are very attractive at this point. The big guys are fairly valued, but can still go up from here. And the little guys are hated. So when they're hated, that means, as Rick Rule likes to say, just going from hated to not hated is usually a doubling or something like that. So that's the first easy money in the junior space in mining. And I think we're, knock on wood, we're in the run up to something like that, where the explorers go from hated to not hated, and make some nice runs in the process.
Yeah, because I know I've sort of talked to a few people about this, and they say that, I guess past 10 years, a lot of the management of these large gold and precious metals companies have been horrible, and their, cash flows have gone down despite the value of gold massively increasing. So is that something that's come into play, where the management are now focused more on, I guess, better capital allocation, focusing on value accretion for shareholders? Is that something that's happens?
Yeah, because the bust that flowed from the last boom in precious metals left a lot of big miners with assets that they wildly overpaid for in retrospect. And so they kind of learned that lesson, and they're being a lot more cautious this time around. And at the same time, for a lot of metals, the grades are falling. In other words, we found the low-hanging fruit. We found the easy deposits. We mined them, and now what we're mining is what would have been considered lower quality back in happier days in the mining space. So profitability is not what it should be with gold and silver where they are right now, and that has had an impact. Yeah. But profitability will improve if at least the price of gold stays where it is right now. And, CEOs of big miners are human, and you give them enough good times, they start to think in terms of building empires. No matter what the past cycle was, if that cycle was 12 years ago, might even be a whole new set of CEOs within a couple of years. And they don't have the same burning humiliation of a memory to keep them under control. And so they'll start paying up for really good, high quality juniors and explorers. And that'll light a fire under those guys. So I think that'll all happen, and you'll still see a pretty aggressive few years of M&A in this space, but it'll take a little longer this time around, because last time around was such a brutal consequence for a lot of these guys who overpaid. So they have to get over that fear. And the way you get over that fear is to see cash just piling up in your accounts. Even after dividend increases and stock buybacks, you still have another $500 million to play with. Once you get to that point, takeovers will start really happening.
Yeah, great point. So, John, thanks so much for your time today. Really appreciate it. Last question is, what is one message you'd like people to take away from our conversation?
Well, so much of the stuff that we talked about is kind of gloom and doomy, and it can be terrifying if you just hear that. So my message is to treat this like an investment thesis, because the financial crises happen all the time, and we get through them. And the people who read them correctly and acted appropriately got very rich. You go watch the movie The Big Short. Go look at the history of the people who not only weren't wiped out during the Great Depression, but they built fortunes then. That's the kind of thing that happens. So our intellectual challenge is to figure out how to be among those people, even if on a really small scale, how to make the decisions that allow us to protect ourselves and our families when this inevitable crisis finally hits. So anyhow, I have a Substack newsletter, and that's what the focus of that newsletter is actionable stuff that we can do to position ourselves for what's coming. And that's at rubino.substack.com.
Great. I'll put that in the description below. Is there anywhere else people can find what you do, or is that the best place?
That's the only place right now. It's the only thing I'm selling is that newsletter.
Okay, perfect. I'll put it in the description. But yeah, thanks again for your time.
Thanks, Anthony. Great talking to you.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment. Good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.